Welcome to the third unit on recording financial transactions. In this third unit, we are going to look at three aspects of transactions. Number one, we are going to look at recording. Number two, summarizing. And finally, posting business transactions. Now, in this unit, we are going to focus on more details on business transactions, how they are recorded, summarized, and posted in our books of accounts. So in the unit 3, we will consider the management of data and accounting systems. There are 6 areas or 6 subtopics under this unit number 3. The first subtopic is an overview of recording business transactions. The second subtopic is what we call day books. Day books are the records where we record what is from the source documents. Number 3, we have what we call general ledger. Number 4, we have what we call receivables and payables ledger. The 5th one is what we call control accounts. And lastly, this information must be recorded somewhere through what we call coding. So we will be looking at methods of coding. So under overview of this topic, whenever transaction takes place, there should be evidence, or there should be what we call supporting document. This supporting document is what we call a source document. So in a source document, it's a record of all the information transacted by the business. Now, once we have the source documents and we have all these information transacted by the business, the information is taken from the source documents and taken to what we call books of prime entry. So books of prime entry are a form of records of all documented transactions from the source document. Examples of books of prime entry. Books of prime entry are also called books of original entry. Sometimes they are called day books. So there are 7 books of original or prime entry we are going to look at. There is number 1, what is called a sales day book. Number 2, sales return day book. Number 3, purchase day book. Number 4, purchase returns day book. Number 5, cash book. Number 6, petty cash book. And number 7, we have journals. So these are the 7 books of prime entry we are going to look at. We've illustrated these documents, the relationship between the documents and books of prime entry, through a chart which is presented as follows. When there is any sales credit notes, we will look at it in this unit, or any sales invoices. These, remember, are the documents. So in this row, we are talking of documents, and then just below the first row, we have books of prime entry. So in these diagrams, we are looking at the relationship between the source documents and the books of prime entry. So every document, we are trying to illustrate where it goes in the books of prime entry. So the first 2 documents, sales credit note, which we will explain in due course, and a sales invoice, they are posted in a sales day book. So the book of prime entry, which records these 2 source documents, is a sales day book. Now, when we have checks received and paid, so if there is any checks received for receipts and any checks paid for payments, they are recorded in a cash book. So the document is check, source document, and the book of prime entry is called cash book. We also have, if we have any petty cash vouchers, any payments we make on a daily basis using notes and coins in the business from the cash till, we record them in petty cash book. So the document is petty cash vouchers. We post it in a petty cash book. These documents are important for managing our businesses. If we have any journal vouchers, they are posted in what we call a journal entry. Finally, if we have purchase invoice and purchase credit notes, they are posted in purchase day book. So in summary, which documents are recorded in a sales day book? We are talking of sales invoice and sales credit note. Which documents are recorded in a cash book? Checks that have been received or paid. What is recorded in the petty cash book? That is petty cash vouchers. What do we record in a journal? Journal vouchers. What do we record in purchase day book? Purchase invoices and purchase credit notes. Now, once we have all these documents, we want to now look at what we call a general ledger. We have what we call ledger accounts. So we have what is called receivables ledger. We have what we call payables ledger, and we have what we call a general ledger. So entries in the sales day book, cash book, petty cash, and even journal entries, they can all go into the journal in the general ledger. Entries in the sales day book and some entries in the cash book, they go in receivables ledger. Entries in the purchase day book and sometimes the cash book, they go in a payables ledger. So note that in a payables ledger, what do we post in a payables ledger? Entries in the sales day book, number one, and entries in the cash book. That is in a receivables ledger. In a payables ledger, what do we record? Entries from the purchase day book and also entries from the cash book. It's important to know this process. Now, once we have posted these in the receivables general ledger and payables, we can now go and prepare the financial statements. But before you prepare or present the financial statements, you must check the arithmetic accuracy of these records by preparing somewhere in the middle here what we call a trial balance. A trial balance checks on the arithmetic accuracy of our postings from the ledgers before they go to the financial statements. There are two major financial statements we are going to focus on: statement of profit or loss and statement of financial position. Now, if we look at the day books, which day books are we going to focus on? Number one, we'll look at sales day book. Number two, purchase day book. Number three, a journal. And basically, a journal is used for adjustments and correction of errors. Errors are mistakes that were made when posting. And then we'll look at cash book. And finally, we'll look at petty cash book. So our first day book is called sales day book. Remember, in a sales day book, it's a list of all invoices sent out to credit customers each day. When we make sales in credit, remember we in the previous session or unit we looked at types of business transactions. We said transactions can either be cash or credit. Now we are focusing on credit transactions. So if we have any list of invoices sent to credit customers, in other words, credit transaction related to goods, of course, they are recorded in a sales day book. When customers return the goods for some reasons, the returns are recorded in a sales return day book. The second day book is known as purchase day book, or the third. It depends on how you look at it. So the purchase day book, in this case, we record all purchases in credit. The purchase day book is a record of all invoices received from suppliers. But some suppliers can return some goods back to the business. We can return some goods back to suppliers. When we return goods back to suppliers, they are recorded in purchase return day book. Next entry is a journal. In a journal, this is where we record adjustments and corrections of any errors or mistakes that were made in our postings. Cash book. A cash book is where we record all the cash received and all the cash paid. So in the cash book is a book of prime entry used to keep cumulative record of the money received and money paid by the business through the bank account. Money received and money paid through the bank account. So a cash book will have two major columns. There is the debit side and there is a credit side of that cash book, where we'll be recording all receipts on the debit side and all payments on the credit side. And that leads us to now what we call a petty cash book. Remember, in a cash book, we record the major cash payments and receipts. But when we come to petty cash, this is where we record the minor payments and receipts that were affecting our cash, that were either received or paid through the cash. So the petty cash book is a book of prime entry which keeps a cumulative record of the small amounts of cash received into and paid out of the cash till or the cash float. The next document is now, or entry or account, is what we call a general ledger. In a general ledger, it is the accounting record which summarizes the financial affairs of a business. We had already presented it through the chart. It contains details of assets, liabilities, capital, income, and expenses, and so profit or loss the business is going to make. Now, it consists of a large number of different ledger accounts, each account having its own purpose, name, and an identity or code. We will focus on codes as the last subtopic in this unit number 3. Another name, and that is important, for the general ledger, it is also called a nominal ledger. And finally, transactions are posted to accounts in the general ledger from the books of prime entry. Remember, we started with source documents, we went to books of prime entries, and then we went to ledgers, whether it is a receivables general ledger or a payables ledger. It leads us to the next item. There, remember, at the third level, the first level is source document. The second level is day books. The third level is ledgers. So we have looked at general ledger. Now we are going to look at what is called receivables ledger. Receivables ledger, sometimes it's called a sales ledger. And now in the receivables ledger, these are personal accounts for customers and suppliers, and these are contained in the receivables ledger and payables what? Ledger. So if it's an account related to a supplier, it goes to the payables ledger. If it's an account related to customer, it goes to receivables ledger. Accounts in the general ledger relate to types of income, expenses, as we had explained previously, assets, liabilities, rent, rates, sales, receivables, payables, etc., rather than person to whom the money is paid. So in our next item, we are now looking at control accounts. Now, under control account, a control account is an account in the general ledger in which a record is kept of the total value of number of similar but individual items. We have two types of control accounts. We have number one, what is called receivables control account, and number two, we have what we call a payables control account. Receivables is related to customers. Payables is related to suppliers. So a receivables control account is an account in which a record is kept of transaction involving all receivables. It is posted with the totals from the day books and the cash book. The opposite of that is a payable, where it's a record of all transactions involving payables being posted with totals from purchase day book and the cash book. So there are two types of controls account. It is either receivables or it is payables. Finally, we have what we call coding. All information collected must be recorded somewhere, either in hard copy or in soft. But in today's business, we record them in soft. Now, these transactions, they can be very many. For example, we can have two different types of customers who are having the same name. So, how do we differentiate them in our system or in our records? By giving each customer a unique code. Each account in an accounting system has a unique code to identify the correct account for posting. In order to recognize the unique nature of each transaction, a business will need a suitable structure of coding within the accounting system. So normally we have three types of codes, which we will see at a later stage. We have what we call numeric codes, we have what we call alphabetic codes, and number three, we have what we call alphanumeric coding. So each business will choose which type of code suits them. Now, codes can be related to different transactions in the business. But the common transactions which need codes are, number one, customer accounts numbers. So if we have different customers, each customer will have a unique number, a unique code, or a unique letter if it's alphabetic. Number two, supplier accounts numbers. The different list of suppliers we have, we should differentiate them with different codes. Number three, general ledger accounts numbers. Number four, employee reference number. Every employee in the organization must have what we call an employee number, or we can call it an employee code. And lastly, inventory, all the stock in the business, all the different types of stock we have in the business. Each category of stock should have a unique what? Code. So codes can affect customers, suppliers, employees, general ledger, and inventories. Now, let's look at around 5 questions on these recording, summarizing, and posting business transactions. So the first question we'll look at, how does the examiner test questions in this topic? That is our focus. So the first question, this topic is basically theoretical. Which of the following statements is correct? A, sales invoice. Remember, sales invoice is a source document. Sales invoices are recorded in the sales return day book and are summarized and posted to the receivables ledger. That is not true. Sales invoices are recorded in a sales. It is not recorded in a sales return day book. It's recorded in a sales day book. So that is not correct. Number 2, purchase invoices are recorded in the purchase day book. That is correct. So all purchase invoices are recorded in. Remember, in A, what was wrong was the return. It was supposed to be sales day book. So B, purchase invoices are recorded in the purchase day book and are summarized and posted in the payables ledger. That is correct. So purchase invoice, they are posted in the purchase day book, and later on in the next stage, they will be posted in the payables ledger. Let's see C. Cash received is recorded in the cash book and posted in the journal. Cash received is recorded in the cash book and posted in the journal. Not true. Yes, cash received is recorded in the cash book. That is true, but it is not posted in the journal. Remember, in the journal, we said it's used to post adjustments and errors. So what is wrong in C is posted in journals. Posted in the cash book is correct, but posted in journals is wrong. And D, adjustments to financial statements are recorded in the cash book. That is not true. Adjustments to financial statements are recorded in journals. Next, so the correct answer is B. Our next question. Which of the following entries correctly records a cash sale inclusive of VAT by a business? So when we make a cash sales and the cash sales includes a VAT, there are 3 accounts that will be affected. There is okay, let's reread it. Which one of the following correctly records a cash sale? So there will be a cash account which is affected, there will be a sales account which is affected, and there will be a VAT account which is affected. So which one is correct? Debit cash and credit sales. This is not correct because of, this is not correct because there is the VAT missing. VAT missing. B, debit cash, which is correct. Credit VAT and credit sales. That is correct. So there are 2 credit entries, VAT and sales, and then you debit cash. C, debit sales. That is not true. Sales is a credit entry. Debit VAT, that is wrong. VAT should be credited. And credit cash, so it's the reverse, it's the reciprocal. And D, debit sales, it's not true. We should credit sales, and credit cash, we should debit cash, and we should also credit VAT. So our correct answer is B. The third question. In the receivables ledger of X company, the accounts of Y, let's reread it. In the receivables ledger of X company, the account of Y company has a credit balance of 5 million. So in a receivables ledger, there is a credit balance of 5 million. Which of the following is a possible explanation for this? Which of the following is a possible explanation of this? So there is a credit balance in the receivables ledger. So which explains that? And the credit balance is 5 million. Ideally, it should be a debit entry. So A, Y company has been sent an invoice for 5 million. That is not true. If they have been sent an invoice of 5 million, it should basically reflect on the debit side. Y company has supplied goods to X company, and these goods have been correctly recorded. No, if they have been correctly recorded, it will be a debit entry. Y company has paid X 5 million twice in an error. Yes, if there is a payment twice, payment is posted in the credit side. So when payment is posted in the credit side twice or in error, it will make, and we paid how many times? We paid 5 million twice. It will make, there will be the correct entry of 5 million, and there will be an overcast of 5 million on the credit side. So C explains why it will be a credit balance if there was a double entry, if there was a double posting, not entry. And D, so the correct answer is C. Y has an overdue balance of 5 million owing to X. That's also not true. So the correct answer is C. The fourth question, it's computational. A VAT registered business sells goods for 1.2 million or 1,200,000 plus 240,000 VAT and purchases goods costing 200,000 plus a VAT. So there are 2 types of VAT which we had looked at in our previous unit. There can be an output VAT and an input VAT. Output VAT is related to sales. Input VAT is related to purchases. And now we say this VAT can either be inclusive or exclusive of VAT. So here you are being told VAT registered business sells goods of 1.2 million plus a VAT of that, and purchase of goods of 200,000 plus VAT of 40,000. Assuming that these are the only transactions in the VAT period and that the input tax is fully recoverable, how much VAT is due, payable to or from the government? So we need to know how much VAT is payable to or from the government. Now this is just a direct one. In the sales, the amount is 1.2 million and the VAT is 240. This is an output VAT. So output, what we should be paying the government is 240,000. But there is also purchase with its VAT of 40. The government should be refunding as 40. We should be paying the government 240 and the government refunding as 40. So what is the net amount? What we should be paying the government is more than what we should be receiving from the government. So the difference is 200,000. 240 minus 40,000. That gives you 200,000, which we should pay to the government. So what is the correct answer? Payable of 200,000 to the government. Receivable, recoverable is not true. It's only recoverable if the one related to purchase was more than the one related to sales. So the correct answer is A. 240 and 280 are automatically wrong. 240 is basically only the output. It has not removed the input. So the correct answer is A. The final question is, which of the following statements is or are correct? Which of the following statements is correct? Output tax. Remember, output tax is tax on sales. Output tax charged to a customer is debited to a VAT. No, it is credited to a VAT. So output tax is credited to VAT account, just like we credit sales. B, a machine is purchased for 200,000 plus VAT of 40,000. Purchase. The machine account is debited with 200,000 and the VAT account is debited with 40,000. The VAT is irrecoverable. First of all, the VAT will be a credit posting. It will not be a debit. Let me reread. Output tax is charged to a customer. No, this is the machine account is debited with 200,000 and the VAT account is debited with 40,000. The VAT is irrecoverable. This statement is correct, but the VAT can be recovered. With time, the VAT can be recovered because it was as a result of what? Purchase. But it can only be recovered if one day the item can be disposed. If the item can be disposed in a future date. So it can be recovered. It is not irrecoverable. Irrecoverable means it cannot be recovered. C, if the VAT account has a debit balance at the end of the VAT quarter, the balance is recoverable from the government. Yes. When the VAT is credit, it means it's output. When the VAT is debit, it means it's input. And we said all input VAT are recoverable from the government because input VAT that is made on purchases. So C is right. D, the sales figure in the statement of profit or loss of a VAT registered business includes VAT. No, it is exclusive of VAT. It is exclusive of VAT. And that brings us to the end of the third unit, which was talking about recording, summarizing, and posting business transactions. Recording, summarizing, and posting business transactions. All the items we have covered here, we will meet them in subsequent topics. So let's meet in our next chapter, which will be unit number 4. Thank you.